there is an exchange or arbitrage of your money getting absolutely more than anywhere else in Australia when it comes to a capital city. And we're seeing that in Melbourne. We're seeing the ability to get big discounts of purchase price, big discounts of valuations. We're seeing the ability for people to buy real estate, and if they buy well, actually come back 6 months later and extract some equity out of real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to get into it. We're going to have a look at the direction of the Melbourne market. I think it's a worthy conversation. Hopefully, I can get through this podcast in record time because I've got little Raffy outside my door, headbutting the door like a goat. He uses his head to bash into the door. It's early in the morning and I've got a busy day. So I needed to crack into this first thing, but that's stealing Raffy's little moment. The little fuzzball is complaining that I haven't taken him out for his morning walk where he can huff and puff. But let's talk about huffing and puffing. Real estate markets grow and, of course, they contract. They puff and puff like little, Thomas the steam engine, and they eventually reach their market cycle and run out of puff. But when we analyze the Melbourne marketplace, there's a lot of puff in it, and I want to talk about that today. So welcome back, regulars. You know the drill. Play the program in double speed. Get your life back. All the episodes I've done are lessons on real estate, so feel free to go back in time if you feel like you need to learn more about property, or you could buy my book. Yes, The Australian Property Game. It's a cracking read. And I was just looking at the numbers. Yes, over 200 people have bought the book. So that's amazing. Who would have thought I could have sold 200 books in this world? But I don't know. If you know someone who needs to learn about real estate, maybe recommend them the book. It's always a good place to start and learn, pay it forward. There's nothing like helping other people understand about real estate. And really, that's my job these days, is to help people understand real estate. And today I want to talk about where Melbourne is located in its economic cycle. I think really when it comes to the idea of looking at a valued-based marketplace, there's probably no better than Melbourne at the moment. Value-based markets are really those markets that are undervalued compared to the broader cycle. And it's fair to say in those marketplaces, you find weakness. You find points of weakness where effectively there is an exchange or arbitrage of your money getting absolutely more than anywhere else in Australia when it comes to a capital city. And we're seeing that in Melbourne. We're seeing the ability to get big discounts of purchase price, big discounts of valuations. We're seeing the ability for people to buy real estate, and if they buy well, actually come back 6 months later and extract some equity out of real estate just purely through the underperformance of the asset and the sentiment of sellers. It's a great time to beat up people selling real estate today. And of course, that creates a lot of potential as to what you can do from a real estate perspective. Now, as I've alluded to a few times on the podcast, there really are momentum markets, marketplaces which, are doing pretty well. They're pretty hot to trot at the moment. And of course, when marketplaces are hot, you tend to get better valuations. Valuations coming in pretty easy because there's a lot of demand and there's a lot of sales happening. So valuers have a a lot of ability to, basically approve a deal. But momentum markets effectively are marketplaces where you have gone past a point where the capital growth is now realistically 50% or less of what is expected into the future. In other words, the market is far more short term than other marketplaces which have not grown, known as value marketplaces, where you can expect long-term capital growth. The real estate market effectively has not gone up in value, so you're not buying other people's capital growth. And of course, in those marketplaces, what you're really betting on is that there is future upside in the market cycle as much as anything else. But with it comes technically lower valuations. You often find there's a lack of sentiment. There's a lack of resales. There's a real inability for the market to perform. And really, it's that lack of performance, that ineffective situation is what you're buying. And I say this all the time, real estate investment is quite often about buying a problem and solving it. Whether it's the problem of, renovating a property, building a property, whether it's the problem of going into a very weak market and being an early adopter, that's the problem that you want to take on. You want to solve problems in real estate. You don't want to sort of just, follow the masses. You want to kind of find something interesting and that stands out as a problem and get into it, really. Now, there are faux pas markets which have not grown in Australia, small communities, towns, medium-sized little regional communities. And the fact that they have not grown is potentially they may never grow. There may be a long time between drinks. But when we're talking about Melbourne, we're talking about one of the largest cities in the world. We're talking about a city that in the next 15, 20 years could actually become a mega city of 8 million people. It's huge. The amount of intake of new people Melbourne creates every year is just astronomical. We know that from the Australian Bureau of Statistics that by 2050, Melbourne could have 10 million people in it. And of course, that means real estate values will go up. It's just a matter of when does the blitz begin? When does the movement actually happen? And there are some signals now that potentially we're already starting to see some movement, and we'll talk about that. But human beings are funny creatures. When you see capital growth in a marketplace and you see statistics, quite often it excites you. Now, think about, for example, if you're watching the news, watching Channel 9 News, and they put on the news, the real estate markets in Melbourne or Sydney or Brisbane or whatever, it's gone up 6% in the last 6 months. You tend to feel as a human being pretty good about that. But conversely, if you saw the real estate market's gone down by 6% in the last 6 months, you tend to feel pretty bad about that. And in behavioral finance, there's a concept known as prospect theory, which is just effectively that human beings feel losses more deeply than they feel gains. They feel elated when they see a gain, but when they see a loss, they feel it more harshly. And it means a lot of people go into their shell when they see a loss. And I often see this when I see statistics put on a screen. You may have a simple bar graph of Australia's growth, and you'll see the growth rate in Brisbane is 6%. The growth rate in Perth is 14%. The growth rate in Adelaide is 12%. In Sydney, it's 9%. And all of that from sensitivity point of view feels good. And then you'll see on the bar graph, Melbourne minus 3%. And you'll go instantly, problem there, growth over here. I feel better looking at where the growth is than where the problem is. And that's known as prospect theory. That's a human condition. That's effectively behaviorally how humans think. Avoid the problem. Avoid the problem. And it's just, it goes back to when we were all being eaten by dinosaurs. Effectively, we run from pain. Yet, if we looked at it through a different lens, we may actually find different opportunity. And really, I've talked about this before with real estate. We want to invert the logic. We want to go, okay, well, when we watch the news, when we see 7% growth in Perth and -3 in Melbourne, we want to invert the logic and go, wow, okay, what's going on in Melbourne that allows me to actually create myself money on the way in when I buy real estate? Invert the logic. So obviously, if, for example, a marketplace like Perth's getting 15% capital growth, which is great, by the way, and again, you have to look in the context of the cycle. Perth went through what Melbourne is going through now. It's kind of 3 years ahead. Brisbane went through this. Back in 2015, I was telling everyone to put their foot into Brisbane. And 2014, buy as much as you can. I was telling people, buy the entire city if you've got the budget for it, because you were going through a period of long-term weakness. And when you go through a period of long-term weakness, the discounts on real estate are spectacular. They are spectacular. Quite often people are waiting for this kind of version of Armageddon that a market capitulates to the point where, everyone's house price is 50% off. But in weak markets, what people miss is weak markets are capitulating, and you can get real estate from 15 to 25% off the purchase price. I haven't seen 50% off, but I have seen up to 30% off the purchase price. And it shows up in a statistic as effectively an average market growth rate of maybe -3%, which when you look at it, you just go, there's nothing, that's not exciting. I'll go with, where the market's doing a 10% capital growth rate. But really what is missing in that conversation is, from an aggregate level, the market is performing at -3%, but at an individual deal-making level, you can find deals 10% off, 20% off, 30% off the price. And of course, that shows up in the data as sophisticated and investors and professional people buying are getting cracking deals. Some of the market that's less used to the nuance of purchasing real estate, it may be, paying the advertised rate or getting a mild discount. But when you aggregate it, it comes out at a -3% growth rate. But that doesn't mean investors are getting -3%. Some investors are getting 20% off real estate. And that's showing up in the deal, what you can put your foot on in the marketplace and how you can pressure the seller, which is just phenomenal. And because real estate is going through a tough time, sentiment-wise, you can track real estate, see how long it's on the market, and really put the boot into the seller to eventually get a very good price. Now, again, if we just used a hypothetical example of Perth having a market growth rate of 15%, and if you were to envisage this in your mind, imagine a bar graph with 15% growth, and on that bar graph, the bar standing up like a skyscraper, doing 15%. And of course, from a horizontal line perspective, we then have Melbourne doing below the bar graph an upside down skyscraper doing deal-based discount 15%. And then, of course, you invert the logic. You then put the minus 15% deal making above the line, and all of a sudden you have parity. One is led by market growth, the other is led by deal growth. And again, this comes back to my 4X growth plan, which is a really simple plan. You can make money doing a deal. You can make money from the location. You can make money from the market, and you can make money from the emotions of the real estate itself, how emotive the real estate is, how well designed it is, what type of real estate it kind of is. There's Rafi banging his head, the little goat. He's trying to get in. He's had enough. He wants me to go to the park. So we got to keep moving, folks. But that's the point of a value-based marketplace. Now, I think we all understand what a property cycle is. It goes in waves. You can go through a boom. You can go through a slump. You can go through an upturn, a rise in the market value. You can end up in a place where, you're sitting in a trough going sideways for a very long time in real estate. And really, this is the point of the Melbourne market. And I say this because I do think a lot of Melbourne locals may end up becoming laggards in their own marketplace. I was just speaking to a friend about investment. They were from Melbourne, and their sentiment around the local market is just terrible. They're like, where should I invest? I haven't bought before. Where should I invest? The sentiment here sucks. And of course, sometimes when you have recency bias of what's going on in your own backyard, you tend to, feel very challenged that actually potentially you're actually in the best marketplace to buy real estate in, not sell real estate, but buy real estate. Now, the property cycle does its thing, right? It goes for a long time, the property cycle, and there's periods of bursting capital growth, and then there's periods of contraction where nothing really happens. But when we think about a marketplace, we can think about the humans that buy in a marketplace. And really that can be broken down into 5 quadrants. You've got those innovators, early adopters, the early majority, the late majority, and the laggards. The laggards obviously pay way too much for real estate and end up losing money because they buy at the market peak, and they're late to the party. They're just simply too late to the party. And there's nothing worse than being too late to the party. It's better to be early than it is late. And so when you think about the innovators and early adopters, they're a small percentage of the marketplace. They're around circa 13 to 15% of the marketplace. And what they do is they tend to buy real estate before the market even moves. They buy basically at the weakest point of the marketplace. And so the early adopters, anywhere from 13 to 15% with innovators, typically will buy at the bottom of the market. They will buy at the bottom of the market. Now, as the market starts to go and capital growth starts to happen, and you're watching the 6 o'clock news on Channel 9, and they're like, Melbourne's just done 7% over the last 6 months. The real estate market's going up $250 a day, $500 a day, or whatever it may be. All of a sudden, the early majority comes in, and they pay more than what the early adopter pays for real estate, because all of a sudden the confidence changes for the seller. Now, the early majority is around 34% of buyers. They end up coming into the marketplace early in the property cycle and do pretty well out of it. So really, where do we want to sit inside a cycle. We want to be effectively an innovator, early adopter, or the early majority. Obviously, if we can be an early adopter and buy at the bottom and time it very well, we can do really, really well from real estate. Then comes the late majority. And the late majority really are buying real estate well past the point where the cycle has done a lot of heavy lifting. In other words, the real estate market may have doubled in value already. It may have gone up 70%, may have gone up 55%. And all of a sudden, the late majority, which is a further 34% of buyers, goes, geez, I'm missing out. I've got to get in. I've got to, if I don't do it now, it's now or never. I will miss the basically my opportunity of owning real estate in this marketplace for the next 10 years. And so they jump in very late to the party when the market is very, very hot, and they pay way more than they need to for real estate. And because we use leverage in real estate, it's funny money, and people don't really put the maths together. The best way to pay off debt in real estate is to not pay too much for real estate. That's it. If you can get real estate half price compared to at the start of the cycle compared to 3/4 of the way through the cycle, you're going to pay off debt quicker. You're going to own the real estate faster. That's it. And so the late majority comes to the party very late in the piece. And quite often the late majority are locals. I had this in Brisbane. I've got some great friends, but they're economically challenged. And sometimes being the person I am, they ask me questions. But I know because I'm their friend, they kind of almost dismiss it. They'd be better off paying for advice from someone else than talking to me. And I often say that to go pay for some advice. Then you will value what I'm telling you. I told them, look, the early adopters are in the Brisbane market now. It's 2015, 2016. They're buying, man. Like, they're buying everything. Like, the early majority is going to come, and the early majority will come, later in that decade. And guess what happened? The early adopters were buying real estate in Brisbane 20% off. The early majority sort of bought at, a fair price, but didn't get a discount. And then when a couple of my friends got into the marketplace, it was very late in the piece. Now, Brisbane's got the flexibility of having the 2032 Olympic Games. So it's pretty time bound as to when the cycle ends. So though they're paying a lot more than they paid, needed to pay, they do have the upside as a late majority of the 2032 Olympic Games, which I think will bring more growth to that Brisbane marketplace, which is devoid of stock at the moment. So bless their cotton socks, they'll probably be okay. But could the same be said for someone buying too late, I don't know, in Adelaide or another marketplace, Perth? Does the late majority actually end up in a place where they're going to be financially better off? The challenge for the late majority in alternative markets is they're not time bound. I don't know when Adelaide cools down. No one knows when Adelaide cools down. And of course, this is where the laggards end up in a situation where they pay too much for real estate. They buy at the market peak. They buy at the top of the boom. And it's 16% of buyers buy at the top of the boom. And I always say this, the A-class investors buy at the bottom of the market. The B-class investors buy as the market is rising. The C-class investors buy at the top of the market. The A-class investors sell to the C-class investors and make a profit. The C-class investors buying at the top of the market buy too late, pay too much, and they're the ones that you read in the paper that lose money. That's it. That's how the system works. So what is the best debt reduction strategy in Australian real estate? Don't pay too much for Australian real estate. Buy at a weak time in the marketplace. Now, I recently explored a PropTrek sentiment survey of where new loan commitments were, excluding refinances. So basically people buying real estate, and where are they shopping? And you can tell from the loan commitments, the loan activity, where people are shopping. We can see that in Western Australia, in Perth, the market has gone up 70% over the last 4 years. It's been booming. And we can see that 36% of investors, interstate investors, are now shopping in Perth. Potentially, they are the late majority, which typically is around 34% of buyers. You can see 36% of investors are now buying in Perth, which to me would seem that they are now paying $300,000 more for the same property that was $300,000 less 3 years ago. The late majority is going to the party. Interesting enough, if you look at Melbourne, only 10% of investors are buying in Melbourne. What could you conclude from that? Are they the early adopters? I would imagine that is the case. The data is explaining what is happening. Now, who are the early adopters? Well, typically they're sophisticated investors, like people who buy real estate professionally, and or interstate investors. And quite often interstate investors have a different lens than locals because they see what's going on in their own backyard. They see the house prices in Sydney are a gazillion dollars. They see, Perth's gone up. They see Adelaide's gone up. And they look at Melbourne through the lens of value. They go, wow, I can't buy that in my local neighborhood. That suburb is very similar to XYZ suburb. Wow, I can't believe the price. And typically the late adopters, as I alluded to, tend to be locals that kind of go, oh, crikes, things have just gone up in value. I better start to act or it'll be 10 years before I can act again because I'll be priced out of what I want. So local investors and local people of Melbourne, this is your podcast. I'm doing this for you because I don't want you to go through what a lot of my friends went through in other marketplaces. You are sitting on a bit of a gold mine, and we're talking Melbourne here. We're not talking Humpty Doo. We're talking Melbourne. You are sitting on a gold mine. Melbourne is a big economic powerhouse. Now, there's a concept in Australian real estate known as 90-day theory. 90-day theory is just the idea that over one quarter, we can see momentum change the sentiment of real estate. Effectively, a market can bump in a quarter and all of a sudden the growth rates start to improve, the sentiment starts to change, you miss the bottom of the market. Now, arguably, we may have just seen the bump in Melbourne. And this is going to create a two-tiered situation in Melbourne where agents getting good results will start to push for higher prices, and vendors who have been holding on for, a long time will probably capitulate and take lower prices. So we're going to see a two-speed Melbourne market, I think, over the next 6 months, where you can still get a bargain, but the bargains are starting to disappear. And 90-day theory is just really simple. A couple of properties go for auction one weekend, and instead of fetching the $1 million expected price tag, they get 1.1, they get 1.2. And all of a sudden, the growth starts to change. And all of a sudden, from a behavioral point of view, human beings start to change. They go, wow, things are happening. Geez, did you hear the news? The market just went up. Now, again, if you were to buy in Melbourne over the next 6, 9, 12 months, you are absolutely going to be an early adopter or the early majority. It's as simple as that. The market has a long way to run because it's been held back for a very long time. Now, a recent PropTrack report just came out that Melbourne just did the best quarter it's done in forever. It's a 5.9% capital growth quarter. Now, annualized over 12 months, Melbourne's just done 1%. But annualized over 3 months, it's done the best capital growth, better than the Gold Coast, better than Brisbane, better than Perth, better than the Sunshine Coast, and better than Townsville. So that tells me something's going on. Will we come back in a further 90 days and look back and go, wow, the last 6 months of Melbourne's just done 8%. Now that's Melbourne inner, the inner ring of Melbourne, when I quote those figures. So that's very interesting. That could create a little bit of a ripple dynamic. Now, in real estate, there is a concept known as mean reversion, the idea that a period of weakness is followed by a period of growth. That you have to assess real estate based on its long-term growth rate. And obviously Melbourne, Brisbane, Sydney, Perth, Canberra, Hobart, they all have a long-term growth rate when measured over 20 years. What happens is if you don't get growth over 5, 6, 7 years, you fall behind your long-term growth rate. But what then happens is to catch up to your long-term growth rate as a marketplace, effectively you get a burst of growth where marketplaces do 15, 20, 25%. And you have just seen this in many marketplaces around Australia, Adelaide, Perth, etc. All of a sudden, the eyes of the Australian real estate market are on Melbourne. Now, Melbourne got beat up during COVID. It was as simple as that. It got unlucky because politically it was handled differently to the rest of Australia. People were incarcerated in their house for a very, very long time. And that killed the mood. It killed business confidence. It killed worker confidence. It killed confidence, killed property confidence. But all of that was a 1 in 100 year problem. And of course, a lot of the human beings in Melbourne are just beaten up. And when you beat up your human beings from a sentiment perspective, that becomes a problem. And really the only major problem with Melbourne real estate is Melbourne people's sentiment. That's it. The jobless rate is low. There's a lot of economic activity happening. It's still one of the world's most livable cities. It's got a great events culture. There's a lot of good things happening inside of Victoria. But if we look at the marketplaces which are trending below their long-term growth average, it's really two marketplaces which are weak, Sydney and Melbourne. Sydney has some capital growth catch-up to do, and Melbourne has a lot of capital growth catch-up to do. When you go to Brisbane, it's tracking at its average, but it's got the advantage of the Olympic Games, interstate migration and affordability to help it keep growing. It will probably overgrow its long-term average. Then you got Perth, which has done a lot of catch-up growth. You've had Adelaide done a lot of catch-up growth. So Melbourne and Sydney have not done their catch-up growth. However, when you look at the difference between Melbourne and Sydney, there's a real interesting diversion occurring. Melbourne is 43% cheaper than Sydney. Now, in 2013, Melbourne was 8% cheaper than Sydney. 8% cheaper in 2013. Now it's 43% cheaper. The last time it was this cheap was 2004, when it was 41.7% less expensive than Sydney. So we can see that even though Sydney's average growth rate has underperformed over the last couple of years, and it has to also grow to catch up to its long-term average, Melbourne is way off track. And really, the imbalance between Sydney and Melbourne should be around 25%, not 43%. And so the difference between where Melbourne can go as close as 7% to the house price of Sydney. So you can imagine just how spectacular the growth rate would be if it went on to do something like that. Melbourne's discount compared to every capital city now is relative. It's got discounts to Brisbane, Adelaide, Perth, you name it, which is amazing. And so this leads us to one of the biggest principles of real estate, intrinsic value. Does Melbourne actually have intrinsic value? And the answer is the right property in Melbourne today is underpriced. It's priced below its average point. And you can drive a discount through buying the real estate well. Now, think about intrinsic value. That's just what's built into the deal today, what you get today. You can buy a property cheaper than what it costs to build a property in Melbourne. You can buy a property with a bank valuation higher than what you pay for it through its purchase price. And that's just today. That's just built in today. Then in the intrinsic value is the total return of the future, rising capital growth and rising rents. And so Melbourne intrinsically has a lot of value in it. Now, I've been working on a deal since February, just monitoring it, hasn't sold. And this is a live example of real estate which effectively the seller has to drop the price, but the price is a fair dinkum discount. Now, the property I've been tracking is a cracking designer-led set of townhouses. Most of the townhomes sitting on the park, which is some beautiful green space, some free land effectively sitting on the asset. All of the townhomes have the same land size and same design, and they're very boutique in their nature. Now, effectively, the neighbours have paid $1.184 million, and that has come in on valuation price. For the unsold townhome, I'm paying $950,000. That's a $239,000 discount below a bank valuation. And again, you could throw multiple bank valuations, and the bank has been valuing it above the contract price. This is the true discount. And again, going back to inversion theory, inverting the logic, when you look at the graph of Melbourne and you see, the growth rate's only 1% and it's 15% in Perth, well, you're not getting a 15% discount in Perth, but you can in Melbourne, and you can invert the logic. You can go, well, I'm going to negotiate a discount to the equivalent of the capital growth rate in Perth. Really, that is what is unfolding. And what I see unfolding is it's unfolding on quality assets. That $950,000 property will become a $1.4 million property. It'll become a $1.8 million property. It'll become a $2.3 million property, a $2.7 million property. Why? Because it's in a cracking suburb, great schools, it's sitting on a park, it's full of infrastructure, it's a low-supplied suburb, and Melbourne's got great economic growth prospects, great population growth prospects, and great economic growth prospects. It's just consumer sentiment is the problem, and that is the weak point of the Melbourne marketplace. which is what today's show is all about. So guys, don't be a late adopter, be an early adopter. Get into it early. It's better to be early than it is late in real estate. That's it from me. I'm going to walk Rafi. Have a good day. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.